This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Up, and away. Stocks have their best start to a year since 2003, and our market monitor says small caps are on track to see big gains now.
Focus on financials. Earnings are underway. So far, they're strong, and this critical sector is the reason why.
No steering wheel, no problem. GM envisions the car of the future, but would you get in one? Those stories and more tonight on Nightly Business Report for Friday, January 12th.
Good evening, everyone, and welcome. 2 weeks into this new year, the bulls are running on Wall Street. Stocks surged to close at records again. In fact, the Dow had its third 200-point gain in 2018. That compares to only 6 during all of last year. Today, financial stocks rose after some of the country's biggest banks reported their quarterly results. So here are the closing numbers. The Dow Jones Industrial Average advanced 228 points to 25,803. The Nasdaq added 49. The S&P 500 was up 18. And it was a strong week for all three. So how does this start to a year compare to others? What might happen next? Mike Santoli set out to find some answers.
Stocks have accelerated into 2018 with a burst of fresh energy, making for the market's hottest start in 15 years. The S&P 500 index has already gained 4% in 2018, the best return over a similar span since 2003, when it was up 5.8%. 2003 turned out great for investors with a 12-month rise of 26%. Though that year, stocks were just emerging from a nasty 2-year downturn that followed the tech bubble. Not exactly a similar setup to this year, which begins nearly 9 years into a bull market. Before 2003, the best 2 weeks of a year was in 1987, a year known for a stupendous 40% surge into the summer before an eventual October crash. As is the case today, the economy in 1987 was humming, interest rates beginning to rise, and public excitement over stocks was starting to boil over. While it's hard to generalize about what a year's start means for market performance to come, in general, a strong gain in early January has led to better than average full-year returns. With growing confidence in the economic picture today and few signs of recession on the horizon, investors are focused more on grabbing a piece of further upside than on worrying about potential losses. Stock funds pulled in $24 billion in new money in the latest week, according to Bank of America Merrill Lynch, the 6th highest total ever. This is leading some strategists to say the bull market has entered a new phase that occurs later in a cycle, when investor euphoria builds and risk is embraced. Yet the rapid pace of gains and rush of new money into stock funds so far this year also hint that we could be in for a more jumpy market. Last year's impressive 19% climb was among the calmest in history, with tiny daily moves and minimal pullbacks. The market this year is making bigger, jumpier moves as investors eagerly chase stocks higher. This will typically make for wider swings in both directions, even if the market's uptrend does continue. For Nightly Business Report, I'm Mike Santoli.
Well, it's not just the market, but the economy that is also picking up steam. And today, we learned that spending is up a lot, adding to a string of strong economic reports. But as Steve Leisman tells us, that could mean an even more aggressive Fed.
For retailers, it was a very, very Merry Christmas. Based on government data reported Friday, the National Retail Federation estimates that holiday spending surged 5.5% for the best season since 2010.
We saw from the Thanksgiving weekend, it was very clear the consumer was back and that retailers were in a good place to respond to the consumer demand. And I think that just carried through most of the season. Online sales showed the strongest growth, with combined November and December revenue in the category that includes e-retailers hitting a record $110 billion. That's up almost $13 billion from last year. With consumers leading the charge, economists now believe that the U.S. registered another 3% quarter of growth in the fourth quarter. That's the third 3 in a row. The U.S. is not only benefiting from domestic growth, but overseas economies are helping as well.
We are seeing a synchronized global growth period, which is really quite rare, and I think that's one of the key offsets of why both the market in the U.S. and markets globally are doing so well.
The one downside, markets now are beginning to believe the Federal Reserve may hike rates 3 times this year. And Dallas Fed President Robert Kaplan said perhaps more than 3.
My base case is still that we should increase rates 3 times this year. I probably have a little more stronger conviction that 3 times, not less than 3 times, is appropriate. It's possible it could be more than 3 times, but that's still the base case.
But it seems as long as the economic data and the earnings are strong, the market will remain untroubled by those rate hike clouds on the horizon. For a Nightly Business Report, I'm Steve Leisman.
And now to those bank earnings that we mentioned a bit earlier. JP Morgan's results were stronger than expected, despite a one-time hit from the new tax law. The biggest U.S. bank by assets reported decent loan growth and got some help from higher interest rates. That sent shares of the Dow component higher.
Well, BlackRock also topped analyst estimates and raised its quarterly cash dividend. The world's largest asset manager now has a record. Sit down for this. $6 trillion in assets under management as investors flock to low-cost funds. The company raked in the equivalent of $1 billion of new client money every day last year. But on the flip side is Wells Fargo, which saw total loans decline and was not able to benefit from rising interest rates, at least not so far. In trading today, shares did what you might expect them to do. BlackRock went up, Wells Fargo went the other way.
Here to dig a little bit deeper into today's earnings and what we might expect to see from other banks reporting next week is Marty Mosby. He's the Director of Bank and Equity Strategists at Vining Sparks. Nice to have you here, Marty. Welcome.
Well, thanks for having me this afternoon.
Let's talk about, you say there are basically 4 catalysts that you think are going to continue to push this particular sector of the market forward. It sounds as though you think they're really in the sweet spot.
We are. This is the last half of the normalization that we started coming out of the recession and financial crisis. Unfortunately, we had 4 years from 2012 to 2015 when we kind of just stalled out and we didn't get any of this improvement that we should have really had, 5 to 7 years ago. But those 4 things are very easy. It's low credit cost. Number 2 is it's rising interest rates, so that continues to push net interest margins wider. It's the deployment of capital. We built up a lot of excess capital that now needs to be pushed back and used more prudently and being productive. And then lastly, you get some operating leverage, expense savings, as well as some synergies from acquisitions. And all 4 of those things are coming together right now to produce growth and profitability.
A couple of the biggest banks reported their profits today. Obviously, each bank has its own individual circumstances. Would you compare and contrast the reports from JP Morgan on the one hand and Wells Fargo on the other for us?
Sure. JP Morgan and the money center banks are having some pressure from the capital markets, so they're not hitting on all cylinders. But even with that, they're being able to grow earnings per share from those catalysts at around 10%. Wells Fargo is an outlier in the sense that it has pressure from the reputational crisis it's dealing with. That's caused it to increase expenses to make sure they're taking care of their employees and their customers as much as possible. It's also caused them to de-risk their business to make sure that there's no more hiccups down the road. That's created some revenue headwinds. Except for Wells Fargo, just one last thing.
Sure.
Super regional banks are the ones that really will benefit the most from this environment.
You really think that we're going to see a considerable earnings per share growth, 30%. So if you're not in these stocks, it sounds like perhaps they are not overpriced yet and have more room to run. Would that be a correct assessment?
It would be. As returns will go up 3 full percentage points this year, we think price to tangible book values that are averaging around just over 2 times tangible book value could round up to somewhere between 2.25 to 2.5. So there is enough earnings momentum to still come and get the outperformance that the banks can still perform as further upside is realized with the profitability improvements that we'll see.
All right, Marty, thank you so much for joining us. Have a great long weekend.
You too. Thank you.
Marty Mosby with Vining Sparks.
In Washington, the Trump administration kept alive the Iran nuclear deal for now. The president waived sanctions for the 3rd time, but said it will not do so again unless the agreement is amended. The White House's statement appears to set a mid-May deadline to make whatever changes it desires.
The Supreme Court will hear an internet sales tax case. That decision could force consumers to pay more for certain purchases and allow states to recoup what they say is billions in lost revenue annually. The case was brought by South Dakota, which has no state income tax and relies in large part on retail sales taxes for revenue.
Kentucky has become the first U.S. state to implement Medicaid work requirements for able-bodied adults on the program. The approval comes one day after the federal government, issued guidance that let states test programs that require jobs or work training as a condition of receiving benefits. Conditions have never been attached to Medicaid before.
Still ahead, food fight. Why you may want the German grocer Lidl to set up shop in your hometown. Have you heard of Lidl? Well, if the German grocery store opened in your town, you probably have, and your wallet may have felt the impact. Courtney Reagan explains.
When low-priced German grocer Lidl opens a new store, it brings a food fight, and consumers are the ultimate winners. The University of North Carolina looked at prices on 48 grocery items at Walmart, Kroger, Aldi, Publix, and Food Lion in towns that also have a competing Lidl grocery store and in towns that didn't have one. The study shows, on average, competing retailers near Lidl stores set their prices more than 9% lower than in markets where Lidl isn't present. The German grocer entered the U.S. 7 months ago and has less than 50 stores so far. More than 50 are planned. While nearly all products it sells are brands only found at Lidl, Lidl says its prices are as much as 50% lower than rival stores. It wanted to see how its entrance to a new area impacted competitors' pricing, which is why Lidl paid the university to do the study. The professor that set the parameters and conducted the study found a half-gallon of milk can be priced as much as 55% lower at competing grocers in towns with a Lidl compared to towns without. Avocados and bread are 30% lower. Ice cream, bananas, and cheese are 15% less in Lidl markets than non-Lidl markets. That means Kroger shoppers save up to $22 on their total in markets where Lidl is present, compared to markets where there is no competing Lidl store. $17 savings at Food Lion, $14 at Aldi, $7 at Publix, and $3 at Walmart. Longtime retail analyst Dana Telsey says Lidl's entrance into a new area does push grocery prices lower at other stores, but Lidl hasn't been as strong out of the gate as first expected.
They haven't gained the share, I think, that originally expected, but you are seeing our U.S. retailers come down and will match those prices. I don't know for how long, though. The pricing power of Walmart, of Costco, is extensive. That getting consumers to recognize the brand name of Lidl takes time.
Walmart declined to comment on the study itself or its pricing plans, but pointed to its ongoing mission to lower costs and prices in certain unspecified categories. The other grocers didn't respond to our request for comment, but the study tells the story, and there's a different ending if your town has a Lidl than if it doesn't. For Nightly Business Report, I'm Courtney Reagan.
Every little bit helps, I suppose. Facebook shares get hit after changing the company's news feed, and that is where we begin tonight's market focus. Yesterday, the social media giant says it wants its users to interact with each other more often, so it is making changes to its news feed algorithm that will result in more updates from family and friends and fewer or less content from brands and media. Facebook says it is confident about the change, even if it means people will spend less time on the platform. Shares fell, though, 4.5% to 179.37. GameStop reported same-store sales for the holiday period that topped expectations, but shares came under pressure when the company said it expects to record a charge of as much as $400 million at the end of the quarter. GameStop owns more than 1,400 branded and AT&T stores and said sales fell in its technology division as more consumers hold off on upgrading their smartphones. Shares plunged 11% to 17.76. Well, the Nordstrom family reportedly still interested in taking the retailer private. CNBC says one hurdle standing in the family's way is securing the necessary financing for a potential deal. Last year, the family's efforts to take the retailer private were stalled by lack of financing and investors' uncertainty around retail's future. Shares rose 3.5% to 51.82.
Aflac is under fire after news site The Intercept alleged the insurance giant exploited its workers and deceived shareholders and customers. The allegations were based off of conversations with several former employees who have sued Aflac. Aflac said the allegations are baseless, and it plans to file for a dismissal of the suit. Shares were off about 7.5% to 84.94. Liberty Oilfield Services began trading on the New York Stock Exchange today. The company raised more than $200 million by offering nearly 13 million shares at $17 apiece, which was above the expected range. Liberty said it will use the proceeds from that offering to pay down debt. Shares rose 28% in their debut to close at $21.75. And the activist hedge fund D.E. Shaw has reportedly built up a stake in the home improvement chain Lowe's. Reports say that the hedge fund is worried about Lowe's performance when compared to its peers, and it's planning to seek changes at that company. Lowe's shares jumped more than 5% to $100.86. And several reports said CBS Vice Chairwoman Shari Redstone is seeking to combine Viacom and CBS more than a decade after the two companies split. But subsequent reports said Viacom is not in any active talks with CBS regarding a potential merger. Viacom shares ended the day up more than 9% to $33.76. CBS shares rose nearly 2% to $58.83.
And time now for our weekly Market Monitor segment. This week's Monitor has three small cap picks he says are capitalizing on the growing demand among consumers for experiences and services. The small cap index, Russell 2000, hit a new high today, up more than 80% over a 5-year period. We welcome Teague Sanders, Senior Vice President and Portfolio Manager at Whittier Trust. Teague, welcome. Good to have you with us. Let's get straight to a couple of your stock picks because we're a little pressed for time, beginning with Monarch Casino and Resort. It's not a name I know, which doesn't say much at all, but where do they do business and why do you like them?
Yeah, sure. So Monarch Casino and Resorts is a regional dominant player in the Reno, Nevada space. And we really like this, particularly because of the management team and the way they've been able to utilize data analytics to better segregate the market and get a better overall customer experience for their user base. The other thing we really like about them is that they're going to really intelligent expansion into the Blackhawk region, which is just outside of Denver, Colorado, which has a lot of similar characteristics to the Reno, Nevada area.
You also like Winnebago, the customer service experience, but they also have, you say, a lot of RVs that they rent out. So they've got a couple different income streams.
Yeah, so I mean, what this is really capitalizing on is our thesis that we're going from, going more towards everything as a service, right? And so you used to talk about experience versus things, and now it's everything as a service. And what they're really providing is vacation as a service. So if you think about the millennials and the younger generation buying RVs and towables and Airstreams, but then there's also companies that come in and buy those RVs and allow people to come in and rent them, which is essentially vacation as a service. So Winnebago is very well positioned to take advantage of this everything as a service movement away from just experience versus things.
And your third one is Bright Horizons Family Solutions. So they are a child care center provider, correct?
That's correct. And so what this is this is on-demand child care as a service. So again, the service is child care. And what they do is they go right in next to large corporations and corporate headquarters and set up the shop actually inside of that facility. And so what this provides is child care on demand. So in this busy lifestyle where we have dual earner households, people coming back to work sooner, it allows for parents to be able to bring their children in the workplace, an environment that they're comfortable with, and a group that they understand. So if you think about on-demand child care as a service, it really fits into this movement of everything as a service.
How do you feel about the market overall, Teague? We have had such a strong run for the last year, and even just since the beginning of 2018. You gave us 3 stock picks, but in general, are you still finding value out there?
Well, finding value versus recognizing that growth is going to be the driver, I think, are two different things. So I agree with you, it's difficult to find value in the classical sense, but we don't see anything on the horizon that's going to cause a major recession or a major deceleration in growth. In fact, we didn't see much earnings growth at all in the last 2 years, and this year we're really expecting to see that. So if we do get that, and we do even see some multiple compression, we still think we're going to see some positive upside in 2018.
Teague, thank you very much. Teague Sanders, Whittier Trust. We appreciate it. You can read more about our Market Monitor stock picks on our website. That would be nbr.com. And coming up, no hands and no steering wheel and no pedals. But GM thinks that's exactly the kind of car drivers are going to want in the not-so-distant future. titan of energy investing is getting out of the industry he helped to shape. 89-year-old T. Boone Pickens closing his energy-focused hedge fund, citing deteriorating health and poor returns. Pickens started out as a geologist, eventually founding Mesa Petroleum. He made a name for himself as a wildcatter, corporate raider, then as a successful investor in both oil, natural gas, and clean energy. The decision to close his fund brings an end to a nearly 7-decade career.
A new passenger rail service is open for business in Florida, but what makes this one different is that it's the nation's first privately funded passenger train. Morgan Brennan takes us on a trip.
It's taken 7 years, but Brightline's fleet of colorful trains are finally barreling full steam ahead, carrying passengers along Florida's East Coast starting this weekend.
So far, in this first phase of our business, which is between downtown Miami and downtown West Palm Beach, we've invested about $1.8 billion in total in the trains and stations and infrastructure upgrades and everything that was necessary in order for us to launch this new private business.
Brightline is the first and only privately funded passenger railroad in the U.S., owned by Florida East Coast Industries, which in turn is owned by private equity firm Fortress Investment Group. While it's not technically a high-speed service, Fortress's billionaire co-chairman, Wes Edens, says it will eventually be profitable.
The rail lines that are behind me are rail lines that were put in place here when Henry Flagler built the railway originally. You can go at grade a maximum of 135 miles an hour. If you want to really go high speed, true high speed, over 200 miles an hour, you basically have to build a bridge for 250 miles that you then put a train on. That sounds hard and it sounds expensive, and it's both of those things. It'll take us about 3 hours to go from Miami to Orlando. A high-speed train might be 2 hours and 20 minutes, 2 hours and 30 minutes, so a huge difference in cost, a huge difference in time to build, and not that much of a reduction in service.
Fortress also owns 1.5 million square feet of mixed-use real estate along the line. And Eden says he's already identified another 8 to 10 corridors across the country where a project like this could make sense. The first leg of Brightline service will run between West Palm Beach and Fort Lauderdale, with service to Miami coming online this spring. And government officials are betting it will boost intercity travel for tourism, but also for business.
This is a long-term project that is going to be immensely successful and really create a lot more economic prosperity for South Florida.
Tickets will be $10 to $15, or the equivalent of toll costs to drive the same distance. Brightline hopes it will drum up demand. Eventually, that will shift to a dynamic pricing model. But work isn't done yet. Fortress expects to spend another $2 billion to extend service to Orlando, work expected to be complete in 2 years. And while it's too soon to know just how all of this will turn out, the project comes online at a key moment, just as lawmakers once again turn to infrastructure, hoping to enlist the private sector to rebuild America. For Nightly Business Report, I'm Morgan Brennan.
Ford and federal regulators are telling nearly 3,000 owners of certain 2006 Ford Rangers to stop driving them. That's because of the vehicle's Takata-made airbag inflators. Regulators say these high-risk airbags need to be replaced immediately. Do not drive the cars. The inflators can explode and spew shrapnel. There have been a handful of deaths and more than 180 people injured.
Are you ready to ride in a car with no driver, no steering wheel, and no pedals? I'm not sure if I am, but General Motors thinks we are. The automaker has asked the government for permission to build and test drive an autonomous drive car stripped of the controls that we've used for decades. Phil LeBeau has our story.
This is the future, according to General Motors. A self-driving car without a steering wheel and pedals, driving around cities, giving people rides in robo-taxis.
Obviously, there'll be an adoption curve, and it'll take some time for people to get used to the idea. But everything we're doing is all about safety in the approach, and we want people to feel comfortable with the technology right from the outset.
GM is asking the federal government to waive vehicle rules that have been in place for decades, so it can put self-driving cars on the road without steering wheels and other controls. It's a radical departure. Going back to the days of Henry Ford, steering wheels and gas pedals have been at the heart of every car and truck. But GM and other automakers believe there's no need for a steering wheel if there's no driver.
We see these vehicles getting deployed, first of all, in a rideshare environment, and that's what we're aiming to do in 2019. Obviously, having maximum space inside the vehicle available for passengers as customers is a benefit of what we're doing here.
Other companies like Waymo are also developing self-driving cars without steering wheels. And late last year, an autonomous drive shuttle without a driver hit the Strip in Las Vegas and almost immediately was hit by another vehicle, which raises the question, will the public feel comfortable in a car where there's no way to take over steering if there's an emergency?
Sounds really dangerous to me.
I feel pretty safe, I think. I feel pretty safe with that.
I would prefer if there was like an option where you could take control over the vehicle and remove it from automation, but I think hopefully that the company put their time and effort and try to protect the users.
GM's steering wheel-free car does have an emergency button riders can push if they need to stop the car immediately. But otherwise, General Motors says these cars will know where to go without a driver or a steering wheel. Phil LeBeau, Nightly Business Report, Chicago.
And before we go, let's take another look at today's record day on Wall Street. The Dow advanced 228 points, NASDAQ added 49, and the S&P 500 up 18.
And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Thanks from me as well. Have a great weekend, everybody. Long weekend. We'll see you Monday for a special edition of NBR.